Costco and Kroger are both excellent companies with fast, growing dividends. But the grocery retailer space is a very competitive space in which it is hard to stay ahead, with very thin margins, low customer loyalty, and the industry is disrupted by the meteoric rise of online grocery sales. One has grossly outperformed the S&P 500 and the other one severely underperformed the S&P 500 in the last 5 years. While they are in the same industry, they have vastly different business models. So it will be very interesting to see who wins this battle. That is what we will find out today, because we're going to compare Costco and Kroger on their financial performance, dividends, future prospects, and valuation. First, let's take a look at Kroger. Kroger is one of the largest food retailers in the world and describe themselves as fresh for everyone and dedicated to our purpose, to feed the human spirit. Kroger operates 2,750 grocery retail stores under a variety of banner names. They have different formats such as supermarkets, digital shopping, price impact warehouse stores, and supercenter-like stores. They also have 170 fine jewelry stores, which, unlike the grocery business, are high-margin businesses. As a fresh food retailer, they also operate 35 food and manufacturing facilities. This is also how Kroger distinguishes themselves, by offering fresh, high-quality products for affordable prices. Kroger does this through their Our Brands product portfolio. This is a significant part of their revenue. More on revenue breakdown in a bit. Through their customer loyalty program, they also collect a lot of data about their customers, which they can use to give their customers a personalized shopping experience. In other words, target them with specific ads, but also to better predict demand for certain products. In their 2019 shareholder letter, Kroger states that they invest in the seamless shopping experience between physical and online shopping. According to them, something not many grocery competitors are doing today. I'm curious to know how they feel about that now, because the pandemic has accelerated this trend and forced all retailers to take this step. And at least in the Netherlands, most grocery stores have done so in the past year, so I'm not so sure if this is still much of a competitive advantage anymore. To further diversify and keep growing, Kroger is also investing heavily in businesses with higher margins, which they call their alternative profit stream. More on that in a bit. All of this is part of their Restock Kroger initiative started in 2018. And then, the second company in this battle, Costco. Fun fact about Costco is that they opened their first store in a converted airplane hangar on Marina Boulevard in San Diego, under the name Price Club back then. Costco has a substantially different business model than Kroger. While Costco is the world's third largest retailer by sales, the firm generates the majority of its profits from its annual membership fees, which make up about 2% of total revenue, but accounts for approximately 70% of operating income. The company has built up a base of over 100 million cardholders around the world. The worldwide renewal rate of these memberships is 88% and 91% in the US. You most likely know this if you're from the US, but in order to be able to shop at Costco, you need to have a membership, and in return you can purchase items at Costco for just above wholesale prices, so much cheaper than other stores. So the membership format is an integrated part of the way Costco runs its business and has a significant effect on the profitability of Costco. But Costco is different in more ways than one. The average amount of different items per warehouse is only 3,700. This is in stark contrast to the 140,000 items at Walmart, for example. I have never been in a Costco myself yet, on the bucket list for sure the next time I'm in the US, but from what I read and can see on pictures, the shopping experience is really without any extra fluff, designed for bulk purchases and self-service facilities, which all keep the costs down. We also have these kind of stores in the Netherlands, but only for business customers. Costco is also working hard on expanding internationally, with now 803 locations all over North and Central America, but also in Asia and Europe. Now that we know a bit about how both stores operate, let's take a look at the size of both companies to get a good grasp on their business. A way to do this is by looking at the market cap. Kroger has a market cap of about 28 billion, but Costco absolutely dwarfs this with a market cap of $168 billion. Besides that, I also want to know how the stock performed over the years. Strangely enough, Kroger only had a price increase of 6% in the last 5 years, with some big ups and downs. Looking out further, over the last 20 years, Kroger did appreciate 5.7% on average per year, including dividends, so that looks a lot better already. But then Costco. Over the same 5-year period, they increased 163%. Also some dips, but mostly up and up. Over the last 20 years, Costco had an average annual return of 12.4%, 5% above the S&P 500. For more predictable returns, I would also like to know how volatile a stock is compared to the overall market. This can be measured by looking at the beta, where a beta of 1 means the stock moves in the same trend as the S&P 500. A higher beta is not always worse, as we will discover here. Costco has a beta of 0.51 and Kroger a beta of 0.01. In the case of Kroger, that translates to the stock almost not moving at all. With a higher market cap, way better price performance and a more desirable beta, Costco wins this first round. An important part of analyzing a business is by looking at the sales and profit of a company. Without it, a company cannot sustainably exist. For a company in the grocery retail space, there are generally two ways to grow. By increasing what is called the same store sales, so the organic increase of sales for existing stores, and or by opening new stores, which obviously means new investments as well. A third component we can add to this is digital sales, and with that, the digital presence of a company. But for grocery chains, this usually does not lead to higher profits, because it adds extra costs with order picking and delivery costs. In the grocery retail industry, the last mile adds significant cost to grocery delivery to already razor-thin margins. In fact, in-store shopping gives most grocers a margin of 2 to 4%, according to research done by Bain. And for curbside pickup and home delivery, this drops to -5 to -15%. So this presents grocers with a big problem. For both Costco and Kroger, we will take a look at these aspects. If we take a look at the revenue trend of Kroger, we can definitely see a clear uptrend over the past 10 years, with an average growth rate of 5%. But what we can also see is that the revenue of Kroger has slowed down significantly in the last 3 years, with the exception of fiscal year 2021. The same-store sales, or as Kroger refers to it, identical sales, have had steady growth over the years, and really ballooned, as you can see in this graph by Alpha Street. Full year 2020 numbers are not yet included here, but identical sales grew by 14% year over year. I do think that 2020 is an anomaly, because of the unique circumstances that were presented to us where most of us could not go out for dinner. For a company like Kroger, focused on fresh food, this obviously helped them. On the new store front, excluding acquisitions, the number of stores has remained quite stagnant. Digital sales grew massively in 2020 with 110% to now over 10 billion, and Kroger expects to double their digital sales by 2023. In order to achieve that cost effectively, Kroger partnered up with Ocado, a UK-based robotics company, to overcome the negative margins. If we break down the overall sales, the Our Brands products also grew significantly year over year, and there's something we have not yet mentioned. Kroger recognizes that purely focusing on the grocery business is a risk for the future, so they've also started to branch out with what they call alternative revenue streams, which include advertising services and financial services such as credit cards. The big question looming there is if it will add meaningful revenue to the overall business over time. So there are definitely some concerns when it comes to the future revenue of Kroger, which I will get into at the end of the video. But what about Costco? The story is quite different for Costco compared to other grocery retailers. That also warrants a different kind of analysis. Costco is a subscription business, not a retail business, and that serves them well. Looking at the revenue trend, we can see that Costco has a clear uptrend with an average growth rate of almost 10%. But the story of Costco lies in their subscription business. And they have a lot with over 100 million cardholders, of whom 88% renew their subscription yearly. Only 2% of their total revenue comes from subscriptions. But their subscriptions have very high margins, as we will discover in a bit. They lure customers in by offering products at prices just 15% above cost, something competitors can't profitably do. I mean, I've never been to a Costco before, but if I read through comments about cheap hot dogs, pizza and Pepsi, I can already feel the inner urge to want to visit a Costco. Costco has also expanded internationally, to Europe and Asia, but most of its revenue is still coming from the US, as you can see here. Just like with all retailers though, there's this one problem looming in the future: e-commerce. In 2020 they grew their online sales by 50%, accounting for 10% of total sales, but so did all the other retailers. And as we have just learned, home delivery and curbside pickup is not good for the margins. Unlike others, Costco has also taken a different approach to curbside pickup. In an earnings call in September 2020, the CEO Richard Galanti responded that curbside pickup is not a priority for them, since traffic inside their stores was stronger than ever. In the 2021 earnings call, it was mentioned that they have only recently started to test it out at 3 locations at the beginning of 2021. And to offer a better last-mile experience for their customers, they acquired Innovel, which is now known as Costco Logistics. Impressively, unlike many of its peers, Costco has made these investments into e-commerce without sacrificing its profitability. With a better revenue growth rate, Costco wins this round as well. Before we dive into the margins, where the battle will take on a new dimension, first a bit about this channel. I'm Tom from the Dividend Attitude Show, and on this channel I make in-depth videos on different stocks, different stock battles like this one, and once a month an update on my personal portfolio. Do you want to join this commenter and others who've inspired me to make videos about a certain dividend-paying company or companies? Let me know in the comments below and I will look into it. Back to the margins. This is where things get interesting. I already left a few clues in the beginning of this video. If we put the latest gross margins of both companies side by side, Kroger wins by a mile with a gross margin of 23%. And there's a reason for that. Costco deliberately sells products just 15% above cost, because they want to pass on value to their customers, by focusing on selling in bulk and exclusive items, all of which one can only take advantage of if they have a subscription, because otherwise you cannot shop at Costco. That brings me to the operating margin. Now, all of a sudden Costco is on top with a higher operating margin, and that is because of their subscriptions, which have ultra high margins, which account for 70% of their operating income. With a better operating margin, Costco also wins this third round. Then we head over to the profits or net income. Looking at the profits of Kroger, the trend is quite messy, with some huge spikes and dips afterwards. And obviously a big spike in fiscal year 2021 profits, despite an almost 1 billion charge for pension commitments. Over 10 years the average growth comes out at a staggering 37% per year on average. On the other hand, we have Costco, with steady uptrending profits each year for an average annual growth rate of 19%. But unlike Kroger, these growth rates are also achieved in the last few years. I feel like I'm repeating myself at this point, but the pillar behind this predictable trend is their subscription revenue, which is very clear if you look at the income statement here. The net sales are shown, after that the membership revenue, and then the gross margin and expenses, both as a percentage of net sales. So this means the membership revenue goes directly to the operating income. From an operating income of 5.4 billion, 3.5 billion comes from the subscriptions. That is amazing. As a dividend investor, I like predictability, and for that Costco looks much better, meaning Costco wins another round. Next up, the dividends. I'm a dividend investor after all, and by the looks of it, most of you are as well. Both companies have somewhat of a similar dividend profile, but there's one big difference. Kroger and Costco are both around 11 to 12% 5-year dividend growth rates, but Kroger has a starting yield of almost 2%, whereas Costco is only at 0.8%. Did I say there was one big difference? Well, there's actually another one. On top of the regular dividend increases of Costco, they also have special dividends from time to time. The last one was for $10 per share in 2020. Imagine that. When it comes to the dividend history, both companies are in the same ballpark, with Costco at 17 years of consecutive raises and Kroger at 15. But how sustainable are those dividends? Very sustainable for both Kroger and Costco it seems, because their earnings payout ratios are 26% for Kroger and 32% for Costco. The free cash flow payout ratios are much of the same, with Costco at 30% and Kroger at 14%, due to an incredible spike in free cash flow. When it comes to the dividend safety score, Costco is at that beautiful maximum score of 99. Kroger is a bit lower at 71, but still considered safe. This mainly has to do with the fears over the future outlook for Kroger. One could say that the special dividends of Costco and the maximum safety score make Costco the winner of this dividends round. But with a better starting yield and slightly better payout ratios, Kroger also has some pretty good things going for them, so I guess it totally depends on your preferences. Therefore, this round has no winner. And then the debt. Always important to take a look at. How good are Costco and Kroger at managing it? Let's take a look at short-term and long-term debt management. We will do this with the debt to equity ratio and the net debt to EBITDA, a proxy for cash flow, which shows us how long it would take a company to pay off its debt based on the proxy for cash flow that is generated. Costco has a very nice debt to equity ratio of 0.55 and has been managing it very well. Their net debt to EBITDA is even more impressive at a mere 0.12. Kroger is also somewhat steady but clearly has a higher debt to equity ratio at 2. The same applies to the net debt to EBITDA at 2.76. Higher than Costco but steady and nothing to worry about. Then the short-term debt management. For this we can take a look at the current and quick ratio. The current ratio measures up the short-term debt liabilities against the current assets. A ratio above 1 is considered good. The current ratio of Kroger is at 0.82, while that of Costco is above 1 at 1.19. Then the quick ratio. This measures the most liquid assets, such as cash, against the short-term debt. For Kroger, this is very low at 0.29, while a ratio above 1 is generally desired. Is this a problem? Not really for a retailer like Kroger. The quick ratio excludes items such as inventory, which obviously a retailer like Kroger has a lot of. Costco is higher at 0.6 but also below 1. In episode 31, where I compared Walmart and Costco, now suggested we could see the same with Walmart. With way better debt ratios and better current and quick ratios, Costco wins another round. Can Kroger still come back from this? I have seen comebacks like this in previous battles, for example with the Taiwan Semiconductors versus Qualcomm battle, so who knows. Before we take a look at whether Kroger and or Costco are undervalued, let's take a look at the future of both these companies. For Kroger, I think the important question will be how much of their customer traffic as a result of the pandemic they can retain. Another important issue Kroger will have to address is the negative margins on online shopping and home delivery. For that, it will be interesting to see how much the robotics of their UK tech partner Ocado can help in optimizing their fulfillment centers and as a result their margins. Important for Kroger will also be how their alternative avenues of growth, their advertising and financing business, will develop, and if it will add substance to the profits. For Costco, it will be important to see how well they will be able to establish themselves in the international markets. In those markets, Costco lacks the economies of scale that it enjoys in the US, and they had decades to develop and optimize their supply chain. But international expansion is vital for the further growth of Costco. And let's not forget that for both these companies it will be important to keep an eye on the battle with Amazon Prime. Vital will be who can offer the best last mile delivery experience in the most efficient way. Purely looking at the forecasted growth of both companies, analysts expect Kroger to shrink their earnings per share by 19% in the running fiscal year, 2022, and then somewhat recover with a 5% growth rate in 2023. Costco, on the other hand, is expected to grow 9 and 10% respectively in the coming years. So with brighter prospects, Costco wins this round. And then the valuation. Are either or both of these companies on sale? According to FastGraphs, Costco seems grossly overvalued and would return a negative 46% per year if it would return to fair value, the orange line, and a negative 20% if it would return to the historical market value, the blue line. Kroger, on the other hand, seems undervalued according to FastGraphs, and could return 23% if it would return to fair value, and 13% if it would return to market value. So there's a lot of risk involved with investing in Costco at these prices. Cross-checking these numbers with another website, we can see the same, where Costco is also deemed overvalued. There, only 4% downside is expected. Kroger is also deemed undervalued there and shows an upside of 32%. So it is safe to say that Kroger wins this valuation round. In this battle there was one main theme, the difference in business models. A subscription-based business versus a normal retail business. There's a big reason why companies like Disney and earlier Microsoft all developed themselves towards a subscription-based model, because it creates predictable and growing sales and profit streams. But as an investor, it is also clear that right now you have to pay handsomely for that seemingly superior business model of Costco. Because don't get me wrong, Kroger might not have won many rounds. I think it is definitely a good business and with the current valuations might be the better risk-adjusted investment at the moment. So Costco wins this battle, but Kroger is definitely a company to consider. Do you want to see more epic dividend stock battles like this? Then definitely check out the dividend stock battle playlist by clicking here on the right. I'm off. Until next week. Bye bye.